and welcome to this part 2 of my video series about the key concepts of day trading. In this video, we're just going to run through the next key concepts so that you really know what you're doing when you're trading. And I hope this can really help you out. So let's go ahead and get into it and look at what you need to make it work when you're day trading. So we've already gone over the other rules. So markets and how they actually work is the first point. And this is a key point to understand really early on in your trading career. And that is simply that the financial markets you access electronically are the same ones you'll see in real life and in person. Okay, so the only difference is that you're using a device and the internet to access the markets. And that's what really makes it online. So the markets you'll see in real life could be anything. So that could be when you go and buy a car, when you're in a market square, when you go to the shops. It doesn't matter. They're all markets because they involve a product or an asset and they involve buying and selling. A lot of people, they seem to get that sort of misunderstood when they go online and use a broker. So although a lot of the time you're not going to own the asset you're actually trading because you're using leverage on a broker, the principle is still the same. And that is simply somebody buys, somebody sells, and a transaction is made. And there's no magic to it. It's just as simple as that. And as you'll see on the charts, when you're looking at them, if you've started trading already, you'll see price goes up and price goes down. And that's just people buying and selling. And as I say, there's no magic to it. It's as simple as that. And you need to be on the right side of that buying and selling. You need to know what's a good price to buy and what's a good price to sell. And you really need to train your eye to understand that. And it's the same as a market in real life. Okay, you know, if you're going out to buy something, you wouldn't buy it when it's really expensive a lot of the time. People would say, you know, I want to get a better price. And the same is if you're selling something you own, you wouldn't really want to let go of it if it was a bad price either. So really, people just don't carry those principles back into the markets online as soon as they step out of real life. And that's a problem. And that's really what this point is about, okay? So you just need to understand that you should trade the markets buying low and selling high because you do the same thing in real life. And it's no different because markets all operate the same way. It's just buying and selling. So when you're buying and selling, you're going to be using analysis to make your decisions. So I thought it was very relevant to have this next point come up on this slide. And that's analysis paralysis. And it's a term lots of people have heard of in the trading world. And it can be a real problem for people because it stops them really seeing what the market's about and, you know, the trading scenario they have in front of them. And it causes them to make poor decisions and lose money. So there's lots of traders out there who believe if you have more indicators, you're going to get a higher trading profit. And it's all about that. And they'll see people who put their charts up and they have loads of different indicators and they think they're a master. And it's just not true. Okay. And it's quite the opposite. The more indicators you have, the less you see in the market because you actually see, you know, all you're going to see is indicators. Essentially, you're not really looking at the price. And it's paradoxical, really. To some, but you know, the more indicators you've had, it doesn't mean you're going to make more money. Okay, it doesn't. The amount of profit you make doesn't rise with the amount of indicators you put on your charts. So it would be great if it worked like that. We could all shove loads and loads of indicators on our charts and make loads of money, and that'd be great. But you know, unfortunately, it just doesn't work like that. So don't be fooled if you see a trader with a chart you can barely see, and you can't see the price and price action. And don't fall into the trap of copying that and putting too many indicators on your charts either, okay? So indicators, they're based from price averages. Everything that they're based on is already on the screen. So you don't need more than 2 or 3 to gauge the price of the market, okay? So any more than this is simply ineffective. It's just going to make things less clear rather than more clear. So stick to a smaller amount, around the amount of 2 or 3, and just know exactly why you're using them. And that's 2 or 3 drawn indicators. So things like moving averages, stochastic oscillators, RSIs, anything that's based on principle, like trend lines, it obviously is excluded from that. So next we're going to talk about overtrading, because this can be a real issue for traders, and I see it a lot. And it gets really dangerous because when you overtrade, you trade more than you can actually afford, and then you can end up losing a lot of money really quickly if the market swings against you fast. So it's really important to understand that when you're going to be trading multiple assets in your portfolio, you're going to have to keep an eye on your risk, and that's going to come down to the correct size of your trades and also how many trades you're taking. Okay, so if you trade more pairs, you're going to have a higher risk because you're ultimately going to be exposed more with your margin. You're going to be exposed more to the market. So what you can do is drop your trading size. If you're going to trade more pairs, that really helps because that's going to stop you having that high risk. And lots of times, traders, they're going to be closed out because they overexpose themselves. In other words, they've got too high risk. Okay, they use up too much margin, and they've got too many pairs trading in their portfolio, and that's a real problem because they're trading too much, and that can really cost them money when things start to go wrong because it can amalgamate quickly. So they don't understand leverage a lot of the time, and that's why they get closed out. So it's great to be trading in and out as much as you can and use the appropriate leverage. And that's as long as you're not trading too many assets that you can't handle them all. Because when they all move against you, you're going to be liable to deal with it. So you're going to need to manage those trades. And if there's simply too many of them with too high lot size, you're going to find they get shut down, you get margin called, and things like that happen. So you really don't want to overtrade. You want to trade less pairs, especially if you're starting out, until you're incredibly comfortable with the amount you have and the size. Also, it's a good idea to start really small as well. So now I come on to the perfect trade. Okay, and the reason why that's in inverted commas is because people often look for their perfect trade. In other words, everything has to line up, everything has to be right, and then they'll pull the trigger. And the real problem with that is that not every trade needs to be perfect for you to make money. It just needs to fit your criteria to give you a bias, or in other words, it needs to fit enough of what you believe based on your criteria. So things that are going to trigger your buy and sell positions. And it doesn't need to be perfect. Not everything has to be fit, but it just needs to give you a bias, so you're more sure about one way the market will go. In other words, you're not 50-50, you're not less than 50%, you're 60, 70, 80, 90%. So it's more than likely, essentially, is what you're looking for. It doesn't have to be 100%, but it's more than likely on average. Remember, it's over time. It's not going to be every single trade that you'll get the trade right, and on average, the price will move up or move down. So not every trade needs to be perfect, because if you look for that, you're going to miss out on lots and lots of opportunities. And that's because it's not going to happen constantly that everything is fit and in line. And also, if you put these lines up, you're going to struggle to make trading decisions, because you're going to say, well, this isn't a buy because on this time frame it's that, and on a higher time frame it's this, and it just causes lots of confusion and problems. Okay, so keep your trading simple, and just remember, you don't need to have every trade being absolutely perfect. So just create your bias in one direction or another. So that means it's more than likely over time that is going to happen. Doesn't need to. We're not looking for certainty, because we don't need it. We don't need to be certain of anything. We just need to be correct on average over time. And that's where your bias comes in. Okay, so don't just exclude a trade based on one factor because you're looking for everything to be absolutely right. Trades, they don't need to be perfect. We just need them to have probability over time. So now we're going to look at overbought and oversold prices, because this is something some people really struggle with, and it links to the last point I just made. And it's simply because lots of traders, they seem to get confused when the market is overbought or oversold, and they'll see that on their their relative strength index indicators or the stochastic RSIs, things like that, because they'll see price is overbought or oversold, and they might read about that, or as I say, see it on their own indicator. And this means that you just need to remember that price can go higher if it's overbought and can go lower if it's oversold. So it makes absolutely no sense to raise your trading size, and you should never do it. You should keep your trading sizes consistent over time. because just because something's overbought or oversold, it doesn't mean it can't keep going that way. And obviously, if you raise your risk, you're going to find that you lose more money, because when it does go that way, you're going to get closed out because your position size is too big. So don't judge overbought and oversold prices as if they're sort of hardline. Price can keep going up or it can keep going down, and don't change your risk based on it if you want to have consistent trading. Okay, so that's it for this video, guys. I hope you've really enjoyed it. I hope it's really helped. Remember, if you want to trade with us and learn our strategy, just go ahead and look in the bio and go to my website. And I'll see you in the next video as well.